right, they should be able to hear you. Jeff, can you hear us?
Yes, I do. Good morning. How are you guys today?
Good morning. We're good.
Are you in Dallas?
Yes, we are.
You know, it's actually 85 and sunny in Fort Wayne, Indiana today. I hope you feel bad about that.
Yes, you've made me very jealous. It was like freezing the last couple of nights.
Yeah, good. I'm glad. The more Dallas can freeze, the better I feel about that. So. Hey, I've got a few things to read, kind of an obligatory disclosure statement at front, and then we'll jump right in. Is that okay with you guys?
Sounds great.
Great. Jeff Shelton is an investment advisor representative of, and securities and advisory services are offered through USA Financial Securities Corp., member FINRA and SIPC. They are a registered investment advisor. Shelton Financial Group, Kara Murphy, and United Capital are not affiliated with USA Financial Securities. And if you would allow me, Kara, I'd like to read a brief bio on yourself. Very impressive, but I think it's helpful for our clients who are both with us in the building today and listening online. Kara Murphy is a member of the executive committee at United Capital, overseeing the investment management team. Prior to joining United Capital, she was Chief Investment Officer at SunAmerica Asset Management. Prior to joining SunAmerica, Kara worked at Chilton Investment Company, a hedge fund, and at Morgan Stanley Investment Management as an analyst researching equities, macroeconomics, and investment strategies. Before joining the investment industry, she was an analyst at Marvin Zonis and Associates with a focus on Eastern Europe and Russia. Kara is a proud alum of Georgetown University School of Foreign Service and the University of Chicago. She's a CFA charter holder, a member of the New York Society of Security Analysts, and a member of the New York Society of Quantitative Analysts. She serves on the board of directors for Grace Outreach, a nonprofit organization which provides educational opportunities and career training for women in the Bronx. She also started an all-volunteer organization called Welcome Home, which provides support for newly resettled refugees. Personally, I met and spent time with Kara at a conference in Newport Beach, California, earlier this fall. I found her to be incredibly knowledgeable and insightful, and quickly realized that we needed to find a way for her to share her wisdom with our clients at Shelton Financial Group. Kara is an important and influential person in the investment industry. I believe she is connected, she is in the know, and I am really excited to be talking with you today, Kara. I know you're a humble person, but your bio is impressive, and we appreciate you guys taking the time to talk with us today. I think the format of what we're hoping to accomplish is just kind of an open mic for a period of time for you to share some insights that you have on what's going on in the markets, what's going on economically, and then at some point we'll kind of transition into a Q&A between yourself and myself. I do have some pre-written questions that we might ask, and we might not. It just kind of depends on how our conversation goes today. So I'm going to transition from where I'm sitting upstairs in our office today to our lower level with Al, who's on the cut screen here. And as I transition down, if you want to just kind of start with your observations of what's going on, and then we'll jump into a Q&A after that. Does that work for you?
Sounds great. So I just want to say thank you so much for inviting me. I love being able to talk directly with folks who, are interested in what's going on in the market. I can spend a lot of time in my spreadsheets and in my head, and so it's really great to kind of be out talking directly with people. And I want to congratulate you on inviting me to talk during a very difficult time in the markets.
Perfect timing. I had this on my radar the whole time, Kara.
That's right. It was very well timed. I appreciate that.
So I'll tell you, and for our clients that are listening in today, it is unusual, frankly, to find somebody from the investment industry that understands the technical and fundamental side of it. You called it the spreadsheets, but also be able to communicate in a way that real people can understand, because most of us are just real people. We're common sense people trying to make common sense decisions when markets don't make any sense. So I look forward to hearing how you explain some of what's going on and can help frame the decisions that we should be making as investors.
Great. Well, I hope I can kind of shed some light. And, you know, if you ever have any questions, I mean, anybody in the crowd, please jump in, and I'm happy to take questions as we go. But to kind of frame where we are, so think about coming out of the financial crisis in 2009, fast forward nearly 10 years, and we've been in one of the longest and strongest bull markets in modern financial history. Now, that's also coming after one of the worst downturns in modern financial history. And what we find is that length of a bull market and even strength of a bull market is not a good indicator for when the market will turn down. So ultimately, I do believe the market reacts to fundamentals. So I spend a lot of time looking at where I think the economy is. And so we've heard a lot of talk about how the economic recovery post-financial crisis has been quite muted. So from that perspective, when we think about, you know, how much overall GDP growth has been, when you think about recovery in the employment market, all of those things were quite slow throughout this cycle. So it's not that surprising that it's taken some time, and this cycle has been longer than what we've seen before. So some of my favorite indicators that I look at to give us a sense of where the economy is going, so think one of my favorites is ISM. So this is a survey that the Institute for Supply Management makes. They'll call up industrial companies once a month and have a very simple set of questions. They'll say, is activity better or worse than last month? Are new orders better or worse? And then so we set up an index, and it gives you a very contemporaneous view of what's happening in the economy. And even though the survey itself is focused on manufacturing, it tends to be a very good indicator of the economy overall. So to give you an idea of kind of this unique situation we're in, the ISM numbers have been quite strong for a number of years. Over the last number of months, so for, you know, the middle part of 2018, we had those numbers at the top end of what we've seen over the last 20 years. So very, very strong numbers. But then looking over the last 3 months, it started to tick down. So the last reading was about 57.3. That's several points lower than where we were over the summer. So what this is telling you, and we're seeing this same theme reflected in other indicators as well, it's not just the ISM, but what we're seeing is that the economy is actually quite strong. It's very healthy. But it's decelerating. So add in the corporate tax cut that we had earlier this year, where companies' earnings were raised by 9%, simply just in a stroke of a pen. We had corporate earnings up within the S&P 500 by 9%. And that's in perpetuity, right? That's not a one-time boost. That's as long as that corporate tax rate stays the same, you're going to have that higher level of corporate earnings going forward. So you had this really big shot in the arm into the economy early in this year that was reflected in economic activity in the middle part of this year, and we're starting to see that decelerate a little bit. Again, still at a high level, but decelerating. So I think that gives us a good picture of kind of where activity is today. So the question is, where is it going to be tomorrow? So for that, we can look at the health of the corporate sector and then the health of consumers. So within the corporate sector, if we look at earnings, so I mentioned that earnings went up by 9% earlier this year. Looking into 2019, we're not going to see that same level of growth. But I just checked this morning, corporate earnings right now are expected to grow into 2019 by 5%. That's a fairly healthy rate, not as high as we've seen over the last couple of years, but still growth. When we look at company balance sheets, over the last 10 years, so during the financial crisis, companies very much ratcheted down their debt, improved cash levels, and then over the subsequent 10 years, continued to, number one, generate tremendous amounts of cash. So the corporate sector has over $1 trillion in cash right now at its disposal. So cash was going up, but at the same time, you had debt levels going up. Now, debt levels relative to cash on hand are higher, but not at extraordinarily high levels. When we look at the cost of paying down that debt, it's still relatively low. So think about how low interest rates are overall. So the cost of actually paying those higher levels of debt is still lower than what we saw 10 years ago. Now the risk is that interest rates go up and the cost of serving that debt goes up. So there's a potential risk out there, but right now without rates going up significantly, we don't see that happening immediately. When we look at free cash flow generation, so that's how much money is coming in the door of these companies that they can use for other purposes. That free cash flow generation has been extraordinary in this cycle. To a degree that we have, so it's been at the highest levels we've seen in history and has continued for an extraordinary period of time. So again, from that perspective, and when we think about next year, earnings overall are going to continue to grow. So when we think about the overall health of the corporation, it's still looking quite strong. So then move over to consumers. During the financial crisis, we know that consumers were very much over leveraged, largely in the housing sector, but also in other forms of debt. That was right-sized during the financial crisis. Coming back out, people have acted much more conservatively. We saw people pushing out home buying decisions, not taking on as much credit card debt. The last couple of years, we've started to see that tick up, where people are going out and buying, they are borrowing on their credit cards, they're borrowing money to buy loans, auto loans. So we're starting to see that start to ramp up. That said, overall, the sort of collective consumer balance sheet still looks fairly healthy. And then marry that with the employment picture, where we have among the tightest job markets that we've ever seen, and wages are starting to increase. And those wage increases have really broadened out to a large segment of the population. All right, so we have companies who are relatively healthy, we have consumers who are relatively healthy, strong levels of economic growth, decelerating. Now let's put in like the real macro picture, because I'm sure you've read about trade wars in the headlines. So this kind of puts the US economy in context with the rest of the world. Anytime you have a trade war or tariffs or whatever it might be, that introduces sand into the gears of the economy. So it's naturally going to slow things down. So far, when you look at like the actual dollar number of tariffs that have been applied, it's a quite small piece of the overall economy. So the real impact is on sentiment. So how much are CEOs going to say, well, gosh, I don't know what's happening with policy. I don't know if I can, sell those goods at the same price that I was going to be able to. I'm not going to build that next factory. I'm not going to hire another person. So it's that knock-on impact on sentiment that is the greatest risk from a trade war. When we think back to that ISM indicator, we've continued to see those numbers as quite strong. So we haven't seen companies significantly ratcheting back on their activity because of trade wars, but that's still a risk. Now, the flip side of a trade war is that it's very easy to solve. Trump and Xi can sit down in an afternoon and have it done. So we saw that with Canada and Mexico, where there was a lot of saber rattling. There are two major trading partners. There was a lot of risk involved with not having a deal done, but they managed to do it, and now we're moving on. So even though trade wars are a big risk to the overall economy, they're easier to take care of and settle. The other thing that I would point out about the US relative to the rest of the world is that, as we talk about that deceleration in US economic activity, even where we are today, which is a little bit lower than where we were earlier, the dispersion between US economic growth and the rest of the world is growing. So when we look at US industrial production, it's at the widest margin from the rest of the world than we've seen. So it tells you that there is a lot of deceleration outside the US. And so the question is, how long can that difference continue? So what's that mean in terms of investments? So I think what that tells us is that there are not huge imbalances that we see in the economy. And I'll add that heading into the financial crisis, it was, as somebody who was on the ground kind of looking at consumer credit and mortgage and housing prices, it was very clear that there were tremendous amounts of excesses that were not being accounted for within the system. So now when I was very early, I was maybe 2 years early in sort of calling that. So I'm no genius, but looking very closely, you could see those imbalances. Today, I don't see that same level of imbalance. The risk is that rates continue to ratchet up and the rest of the world really slows down relative to where we are. So I think in 2019, we're likely to slow. I don't yet see recession on the horizon, but there are macro risks that we should be addressing that could present a risk to that outlook. So let me just pause there because I know I rattled on for a little bit, and I'm happy to dig into any one of those topics a little bit more.
Yeah, so I think what I heard you saying is that generally the fundamental data that we see is still encouraging. There's nothing that is an immediate red flag from your perspective. Is that accurate?
Yeah, I agree. I think the fundamentals still remain solid. The biggest risk are those macro risks, like on the trade wars.
Yep. Other than that, any other pending issues that you can think of that, and we never know what that next real influence will be. That's why it's always a surprise. But what might some of those other influences possibly be besides the trade issues?
So one other issue that we're looking at a lot is the interest rate environment. So the Fed has been raising interest rates for a number of different years. They've also been, if you think about how during the financial crisis, they went out and they just bought huge amounts of bonds. So their balance sheet just exploded with all these bonds that they had bought. So as you have rates ticking up, then you have them selling these bonds. Both of those impacts pull liquidity out of the market. So we've been in this, process for a number of years of kind of pulling down that number of bonds that they own and then bringing up rates in order to just slow things down a little bit. So we are a number of years into that process. And, it's interesting because just based on this morning, I was looking, the Fed was expected to have another rate increase in December. The market is starting to back off of that. And so it's very possible that the Fed won't raise rates in December. So the risk there is that despite kind of global economy weakening, that the Fed continues to barrel ahead and raise interest rates. So I think the Fed is going to tread very carefully. They've been very careful in going out and communicating with people about what their, any potential change in outlook has been, because they want to not pull the trigger too much. So, but we are watching very carefully, and the market is very concerned that the Fed is going to be too aggressive.
Yeah, are you surprised that we haven't seen more negative returns in bonds, generally speaking, with both of the influences that you mentioned, rising interest rates and basically them throwing some extra supply on the market? I know personally I expected there to be more chaos in the bond market. What's your perspective on that?
Yeah, I agree. And I think, when we think about potential risks in the market, I think there are a few pockets of risk in fixed income in general. So if you think about overall corporate debt, the length of corporate debt has extended over the past couple of years. There's a good reason for that. Interest rates were so low that companies were like, you know what, we used to borrow over 5 years, let's borrow at 10, because we can borrow at 10 for the same rate that we had been at 5. Right, so the duration of that debt has extended. But what that means is that as interest rates rise, you have more risk to the bond price. So I think we have to be very careful about the embedded durations in our fixed income portfolios. One other potential area of risk is further out in the credit curve. So when we look at high yield bonds, so these are companies who don't have as strong balance sheets, lower credit ratings. They've been able to have a tremendous amount of access to credit and spread. So the amount that a high yield company can borrow at relative to a high grade company or a much stronger company is at historic lows. So when you think about, there could be some areas of the market that I think are at risk going forward. Now, I actually agree with you in that I am surprised at how much fixed income overall has held in so far this year. And really that's because when we look at those long-term interest rates, they haven't come up the way that they could. If we really started to see inflation ticking up, and then the yields on the long end of the curve start to tick up, that's when you're going to see more declines in the fixed income side.
Yeah, yesterday as I was doing some reading, and one of the programs that I watched talked about the inverted yield curve that we recently saw, and that's at least from these experts' opinion, a 100% predictor of a recession within a certain number of months. What's your perspective on that?
Yeah, so this goes back to what we were talking about a little bit earlier, that risk that the Fed presses on the brake too hard. So my favorite way to kind of evaluate where the yield curve is to look at the 2-year Treasury yield versus the 10-year. So right now, when you look at the 3 to 5, so that's this kind of center of the curve, that has inverted. And so that's what got people's eyes up. In my mind, that's not our best indicator because it's not really telling us that much. It's really the 2 to 10, or sometimes you'll see the 3 months to 10. Now that said, the 2 to 10 as of this morning, well, as of yesterday was 11 basis points. Today it's 19. So we're still very, very low and at risk of dipping below 0. So that would mean a yield curve inversion. And you're absolutely right. Since 1950, every time the 2-year yield has gone below the 10-year yield, we've had a recession. Now that said, those recessions haven't come for 6 months to 2 years. So again, they're a very good predictor. They're not a very good timing indicator. And when we look back at the 1990s, I was just pulling up these numbers yesterday. When you look back at the 1990s, for a bulk of that period, you had the yield curve, that 2 to 10 yield curve, bouncing between 0 and 50 for a number of years. And as we know, that period was a very, very strong economic growth and very strong stock market. Now, we put on top of the fact that we're 10 years into this cycle. So there's that, like, this is something that we're watching very closely. And I think it's an important indicator, but it's also not an indicator to head for the hills.
Okay. You know, it's surprising after such a long time of watching markets. We've had basically two 10% drops in market value this year. And yet, prior to the beginning of this week, we were still positive for the year. That shows some real resiliency in this market, or does it just show stupidity? Is there just a lack of recognition for what's real? I mean, 10% drops in the same year, and the market still has a positive return. How do you account for that?
Well, I would never call anybody stupid. So I think the market is grappling with conflicting signals. So go back to like 2017. We had one of the lowest levels of volatility that we've ever seen. There was hardly a day with a move more than 1%, which we almost never see. So the VIX, which is another measure of volatility, was also at extraordinarily low levels for that period. Now, going into 2017, I really felt that volatility was going to pick up. Because one of the biggest drivers for that overall volatility, we touched on this a little bit, is just general liquidity. So you know, again, coming from that starting point of like 2008, 2009, where you had, you know, a tremendous amount of instability throughout the financial world. You had the Fed doing everything it could to pump liquidity back into the system. And the Fed was joined by every other major central bank in the world. So that was a period where just a tidal wave of liquidity was coming into the market. Starting a few years ago, the US central bank was one of the first ones to start pressing on the brake. And it wasn't until very recently that we've seen other major central banks start to tighten. But what happens then is you have central banks working at cross purposes. And that's where the volatility ultimately comes from. So in my mind, that's why heading into 2017, I would have expected that year to be a much more volatile year. As it turned out, that volatility was kind of pushed out. And again, it's this question of conflicting signals. So you have, you know, the US central bank doing one thing, Bank of Japan doing another, and then you layer on the policy questions, right? We talked about the corporate tax cut, how impactful was that going to be? Now layer on trade wars. So these are very big issues that the market is dealing with. And I think I would describe the market today as a bit of a frayed nerve. So if you think about, you know, I know when I've had like a toothache and then you touch the tooth a little bit and your whole body kind of jerks up. That's kind of where the market is today, where every little headline about whether it's the Fed or trade wars will have the market shooting up and down in one direction or another. So I think about this morning on my way to work, I heard the headline that an executive from Huawei was arrested, which had negative implications for a trade deal between US and China. The futures were actually up before that headline came out, and then they ratcheted down when that headline was released. So again, like, I don't think that one thing is going to have that great an impact on the market, but we're reacting in a very emotional way. And so I think that's the course of the volatility. And then once that volatility is in the system, it has a tendency to continue to remain volatile. So the bottom line is, I think this volatility will continue because we still have conflicting signals. And this is more of a normal market environment we were sort of lulled into the sense that markets move a little bit every day, but a more normal market is where you're kind of moving around a fair amount all the time.
Yeah, so the volatility that we've seen very recently, just in the last few days, is there, in your opinion, some technical or fundamental basis for it, or is it the raw nerve that just got tweaked?
I think it is the raw nerve that got tweaked. Now, again, that doesn't mean that there's no fundamental basis. I just think it's an overreaction to what those headlines and those concerns that we've had. Now, one other thing that I would add, which again we're watching, is from a technical perspective, the market does not have technical support that it did. So this is, there's a whole swath of the market that reads charts. And so, you can pull up a chart of a security and you look at certain indicators and that will tell you what's going to happen going forward. Some people buy into it, some don't. But it is, in some ways, a self-fulfilling prophecy. So I'll give you an idea. So when we look at the percentage of stocks that are above their 200-day moving average or their 50-day moving average, less than half of stocks are above those two moving averages. So what that tells you is that there's a deceleration very broadly in the market. Another thing that you might hear in the headlines today is this S&P death cross. I love the fact that traders can come up with these like very dramatic names for what's going on in the market. The death cross is one of the most dramatic. So that's when the 200-day moving average is turning down and the 50-day average is moving down and one crosses over the other. Now, so these are an indicator of sentiment, an indicator of declining momentum in the market. But the question is, how predictive are they? And in general, after you hit a death cross, often the S&P, more than half the time, the S&P is up afterwards. Also, when we look at momentum, how much does it tell us where a stock is going forward? Typically, those very short or very long momentum indicators are really short-lived. And so they don't give us a sense of where a stock will be, say, a year from now. So I think again, sentiment has been hurt, and we're going to need to see the S&P come back up in order to get that confidence back in. And so it's just another indicator that we're watching, but I think sounds a lot worse than it is.
Another surprise this year, beyond the bond conversation, is internationals. And I just wasn't expecting internationals to perform as unfavorably as they have. What do you see going forward with internationals generally?
So we talked about how like the U.S. economy has kind of been pulling away from the non-U.S. economy. So in the near term, we still see the U.S. healthier than what we see outside the world. Now that said, the U.S. valuations, right? So how expensive are U.S. stocks relative to outside? U.S. valuations are much higher than what we've seen elsewhere. Emerging markets, so if you think about, way out that kind of risk spectrum from U.S. to international, in emerging markets, we've had among the worst performance we've ever seen in emerging markets heading into 2018. Now, I am at heart a contrarian, and so with that, there is a feeling that emerging markets are having some of they're among the cheapest that we've seen. If you think about long-term demographic opportunities, that's still very much in emerging markets. So I actually think there are opportunities there. But again, when you think about if the U.S. markets are growing more volatile, emerging markets are going to be even more volatile. So, I'm a fan of having exposure to those non-U.S. markets. I think it's very important. I think those non-U.S. developed and then emerging markets go through some very long swings. So you can have several year periods where they'll underperform, but then you can have other several year periods where they'll greatly outperform. So I'm a big fan of just maintaining exposure to those because it's very hard to sort of predict when that cycle is going to change.
How about growth versus value? Do you think growth in general is played out and value becomes more of a play?
I do. So this is getting to the contrarian in me as well. So for almost every year since the market bottomed in 2009, growth has outperformed value. So if you look at that relative performance, that's the greatest dispersion in growth versus value since 1999. Now, from 1999 to 2000, growth continued to outperform. But then, of course, we know what happened in 2000. Growth really crashed down and value massively outperformed. So again, when I think about the relative risk and where you can find return going forward, I would favor value. And I think we started talking about this in the summer, expecting a rotation out of the kind of growthy go-go names into some more defensive, value-oriented areas. And we've seen that happening over the last couple of months. That doesn't mean that this is the definitive shift, but when I think about where there are more opportunities, it's going to be on that value side.
You've been managing money for a long time. In your experience, what are the 2 or 3 mistakes that you see investors make? Those investors that aren't successful long-term in investing money. What are 2 or 3 things that you see that if an investor could just avoid these, it increases their ability to be successful? Doesn't guarantee anything, but what are those 2 or 3 mistakes you see?
I will give you the one single most important mistake that people make, and that is to react emotionally, to not have a plan when you go into a situation. Panic is not a plan. And this goes for individual investors, institutional investors, like your largest investors are subject to this. And there's this great quote from Warren Buffett that I love, and he says something like, he's one of my heroes because he always has a plan. And in this quote, he says something like, it's not IQ that's going to determine investment sense. It's the emotional wherewithal to work through those cycles. And it's so interesting that, here's a person who I consider like the greatest investor of our time, who's saying it's not smarts, it's not access to information, it's not a better calculation or forecast. It's being able to have that emotional fortitude and the common sense to be able to live through those cycles. So I've unfortunately learned this the hard way over 20 years in the business. And that when you're in the moment, it's very easy to have this emotional reaction, either positive or negative. But if you have your plan heading into that, if you understand where your risks are, if you're willing to live with them, you should by and large be sticking with that through it all. And I know that's it's sort of an unsatisfying answer, right? Everybody wants, it's this particular measure of PE that's going to give you the best indicator. And it's really not. What really gets the best of us and what hurts returns over the long term is emotions.
Yeah, I've heard it called, instead of IQ, it's your EQ, it's your emotional quotient. How emotionally strong are you at staying the course with what you believe? Just out of curiosity, how many times in your career has the stock market went to zero?
That's a great question. 20 years and it's never gone to zero.
Never went to zero. Has it been bad before
Awful.
in 20 years?
Awful.
Yeah, it's been awful. Has it ever bounced back to where it was before it got awful in your 20-year career?
Every time.
Every time. It is hard for me to remember that because we take it
Absolutely.
so personally. Whether it's my money, your money, or any of the clients' money that we work with, we recognize that. But it is so difficult to maintain that emotional stamina through those difficult times. And I don't think it's going to get easier. One of the things we committed to was hiring firms like yours to help us manage money for our clients because the signals are more difficult today to discern than they were in the past. I believe that. So
I agree.
Thank you for the efforts that you and your team put in. I think we have a few more questions here. Al, was there anything specifically that you wanted to ask Kara?
I have a couple of them.
Now, if these are going to be like really detailed.
No, they're not going to be really detailed.
Okay.
I can get really detailed.
I know you can, my friend. Tomorrow, all you want about that stuff.
But looking forward in 2019, you mentioned value as maybe a focus for 2019. Are there specific sector opportunities that you think might be more attractive than others going forward?
Yeah, so I'll throw out another contrarian idea, which is financials. So, think banks, investment companies, asset managers, insurance. So overall, I think financials have been incredibly beaten up. So coming out of the financial crisis, they never really sort of took off during that time period. And for good reason, right? They had a lot of excesses to work out, they had a lot of capital to rebuild, but you also had regulations that were getting tougher. and interest rates were so low, it was very difficult to find opportunities to actually make money. So roll forward a number of years, regulation has at least stabilized. There's a potential for it to come back a little bit. There was a lot of fear with the Democrats taking over the House that regulation would get even tougher. I find it hard to imagine that regulation will get even tougher on financials right now because they're incredibly strict. And then when we think about like that consumer balance sheet, that corporate balance sheet, they're still relatively healthy. Now, I think if we're worried about potentially heading into recession within the next year or two, within financials, insurance is a really attractive opportunity. So these companies also, had the same issues we just talked about, where capital, increased regulation, and not being able to have yields to buffer their earnings. So they're not going to have the cyclical impact. So, if credit gets really bad, that's not going to impact an insurance company, but interest rates have gone up significantly over the last couple of years, and that hits immediately to their bottom line. So I think that could be a really interesting area going forward. One other one that I'll mention, which is actually not necessarily in the value space, but I think is interesting, is healthcare. So coming out of the midterm elections, when we think about, any of the market-related questions that were at play during the midterm election, healthcare really got the clearest signal with those results. We had the Democrats taking over the House. With that, the Affordable Care Act is, virtually assured to be in place for at least another 2 years. My feeling is that the longer the Affordable Care Act remains in place, the harder it's going to be to dismantle it. So I think even longer term, it's likely here to stay. And then we saw in a number of states there were votes to expand Medicaid. So the combination of those two means that the pool of customers for healthcare companies increased because you have more people with access to insurance. So in general, that's going to be a positive bottom line growth opportunity for healthcare companies. There is a risk that there's going to be more pressure on drug prices, and so I think that remains to be seen. But the one certainty is that the pool of potential customers has increased.
So what do you think about small cap versus mid cap versus large cap in 2019? Any preference there?
So another kind of anomaly for this cycle has been that large cap has outperformed mid and small for virtually the whole time. And that's usually not the case. Typically early in a cycle, small cap will outperform, and then as we get into late cycle, large cap will outperform. The other particularly interesting thing about large cap outperforming is that so large cap companies tend to have a much larger share of their earnings coming from outside the US. So you would think with the advent of trade wars that they would be harder hit than small cap. And that's not what we've seen. In fact, the Russell 2000, which is the best index for small cap, looks like it's almost down 20% so far from its peak. So that tells me that it's not just trade wars that are impacting the negative market sentiment. It's just more the sort of like general risk off sentiment. So going forward, I tend to, again, because I feel like we're going to have this deceleration in the economy, I favor areas of the economy that are less tied to top line GDP growth. And so you can find areas within small cap that sort of fit that bill. You can find areas within large cap. So I don't necessarily have a strong feeling large versus small going forward. And I also do think that we will come to an agreement with China in terms of tariffs. So that's going to be one of the big risks on large caps that's going to be removed. So going forward, I don't see a huge difference between the large and small cap.
So what about, FANG stocks? Huge press on FANG stocks, and they've just been plummeted recently. What do you think about FANG stocks going forward?
So FANGs have been the absolute darlings over the last couple of years. I remember when this moniker first came out, and I had to keep looking up what FANG stands for. So these are companies who were massive disruptors in their business. So Facebook, right? Social media didn't even exist a number of years ago, and they have been a player who was able to sort of, take the market and be able to continue to expand their share, and they've reshaped how we communicate with each other. Apple, same thing. Nearly every household in America has some sort of Apple product in there, and they have this closed ecosystem, something that very few companies have been able to do. Google, same thing. So these are companies that have really reshaped the businesses that they work in, and being able to do, and they're also all monopolies to some degree or another. Netflix, same thing. So they've been able, and with that, sort of tremendous growth opportunity, and the very, if you think about a competitive moat around their business. So this is something that, again, Warren Buffett talks about. When you think about creating a competitive moat around your business, each one of those companies has them. So they've been able to increase earnings, and earnings have gone up, and then valuations have gone up even more on top of those earnings. So huge stock price increases. But that can't go on forever. And so at some point, that growth decelerates, or that incremental valuation that you put on that earnings growth has to start to subside. And what we've seen is that there have been a couple chinks in the armor of these companies. So Facebook was facing privacy issues, security issues. With Apple now, we're starting to see somewhat deceleration in growth of new products. So you're starting to see chinks in the armor come in. And with that, sentiment has really turned. So it's not all fundamental, but I think the stocks have maybe gotten ahead of themselves heading into this. So again, that gets back to this theme where I would be rotating out of those names and into more defensive names.
It's interesting. We had a question that says, with the demise of GE, are there other major companies that may falter for similar reasons, and does it matter to the market? But it's just interesting how GE isn't even a conversation anymore. It's Facebook, Amazon, Google. The companies that do have an influence on the market have changed materially, haven't they?
Oh, absolutely. And I mean, this is part of the creative destruction of the market. So you think about like the Nifty 50. Yeah. Those names that were in the Nifty 50 several decades ago, many of them don't even exist anymore. So it's part of the constant like recreation of how we do business. And I think that's a very healthy thing. And that's the wonderful thing about the American markets, is that we're able to constantly sort of get better and rethink how we're doing things. But that's also why you can't just count on, like, let's just buy a blue chip company and kind of leave it forever, because things do change over time. IBM is another example. I don't think they're necessarily, going to run into the same kinds of issues that GE did, but another very, very large, very successful company that's had trouble sort of reinventing itself as we move forward. That doesn't mean it won't be able to, but it's a difficult transition sometimes.
Yep. Kara, we're at 40 minutes, and we need to close up here today. Christian, I want to just say thank you for all your input and suggestions and ideas.
I'm happy to be the mouthpiece whenever.
Yeah. At some point, just a conversation with you would be amazing also. So perhaps the next one is just you doing what we just did with Kara. So thank you. And to your whole team there, for Peter Kim, I think you might be on the phone. He's a genius, and we appreciate you giving us access to him on a regular basis. He has been in our building, and he has been at our client events. And so it is so helpful when we have people that are on the ground doing what you guys do, talking not just with us as advisors, but also with our clients. So, Kara, I want to say thank you, Christian, Peter, and to whoever else helped put this together.
Well, thank you. And I appreciate everybody listening. And like I said, I love talking to folks, so hopefully we can do it again soon.
Sounds good. Thank you so much. Have a great day.
Take care.
Thanks.
Thanks, everyone.